how do I think about this? How do I say, I'm underwriting a deal? This deal, I have a premium that is $15,000 a year, but I'm worried that it's going to double to $30,000 on a property where that's 50% of my margin.
Exactly. And people are always asking, how can I lower it? How can I lower the price? These premiums. What things are they looking for that will help give you some relief on that price? Some of the things you just mentioned are great examples on being able to save money.
Welcome everybody to Self-Storage Income, and today we have a extremely important topic. This has been a problem for the last few years, and a lot of people are wondering what's going on. How do we underwrite this, expenses with insurance, and everything that's gone on, especially what we've seen through California and others. It's become one of the larger expenses and one of the more, I think, unpredictable ones. So with that, I have my friend Terry Campbell on here. We've worked with Terry for actually a long time. He worked in the banking sector and really built out Live Oak's self-storage side, and he is now doing the same in the insurance world. So with that, Terry, how's it going, man?
It's going great, man. It's awesome.
Good. And you just couldn't stay away from storage. And so you're back in trying to help people solve more problems.
Yeah, I couldn't stay away. I, tried to retire early. It was a year ago last week. And after about 4 months, I told my wife, I'm going to have to go back to work to get some rest because this retirement stuff's killing me, all these projects and things. And so ended up coming back into the industry to start a vertical at an insurance company, like you said. And because I've done the building side, I've done the lending side, operation side. This is one of the few things I haven't done yet specifically. And so I'm rounding out my self-storage knowledge base, I guess you could say. And at a time where everybody's interested in talking about it.
Yeah, it's been a wild few years. I've seen a lot of people get in trouble with it, actually. The Southeast has been an issue, and then now we see it on the West Coast, but we've been dealing with it throughout the Midwest, even too, where we saw insurance premiums just skyrocket. So, first and foremost, when looking at this, when we're talking about property and casualty, we're particularly talking about the coverage over the actual buildings, the asset itself. So, what happens if it burns to the ground? What happens? Tornado, hurricane, on, and covering that. And then, how's that all work? I think really driving it, we get the fundamentals of insurance, but the property casualty side, there's a few different ways you can go. But in self-storage, are there a lot of carriers? Is this something that carriers like to cover?
Well, we have over 10 carriers that we can go to. It depends on the location across the country, but we have over 10. And we're constantly looking for more that are getting into it. There's a couple that I've heard that are kind of rolling out of the market. There's a couple that are rolling into the market. And some of the ones coming in are trying to be a little more aggressive on their premiums to try to get established in the self-storage world. And those are good reasons to work with an independent agency. So you can always have access to multiple carriers like that. And when you do have the independent agency working for you and getting all these quotes, they can advocate for you. They can sort of negotiate for you. I hate to say it like this, but you can kind of almost put one against the other and say, hey, we've got a quote over here for this. Can you do any better? And so our ultimate goal is to help our client get the best package. And obviously the best package would hopefully include the best price, but making sure that you've got the proper coverage. It's amazing how many that we've looked at that have been so underinsured. They didn't know it. They were self-insured and they didn't know it. One was 7 figures underinsured and they didn't know it. And, there's a lot of, I think, automatic renewals that have kind of gone over the years and people haven't really looked at it when the cost to replace it has gone up so much, especially when you get into areas that sometimes have high cat risk. The coast, some of the Sun Belt states, parts of Texas and Oklahoma, some of those places. And we see a lot of folks that want to disagree with the replacement cost that the carriers are putting on. And I get it, having been in the building business myself for 20 years, I understand what you're saying and that the square footage seems awfully high. But if you're in an area that's high cat, if you get hit in the path of a tornado or a hurricane and you got hundreds and hundreds, if not more, of properties that have been damaged. And now you're not only competing for the materials, you're competing for the labor to replace it. So what happens? Prices go up. So the prices don't seem like they're correct when you see some of these replacement costs that are being put out there by the carriers. But in fact, they're based on payouts. So that's sometimes we hear a lot of pushback and get a lot of pushback on that.
Now, we have carriers that are, though, they're getting out of certain areas. We've heard of this happening. We heard about this in California, and I know that they don't want to insure people there. And I've also heard in Florida of this happening. Is that something that you're seeing as a problem with self-storage, that in these areas your choices are getting limited?
Some, number one, are just getting out completely. I'm not fully sure I understand that, but definitely certain areas that are prone to high cat risk. Hurricane, Sunbelt states, coastal areas. Texas is tough. Texas has been really tough, especially when it comes to wind and hail. You may be able to get coverage for certain things, but when it comes to wind and hail, that's a different animal. We quoted in Northwest Houston. It's outside of Houston. It was a brand new boat and RV fully enclosed facility, nice new facility. And the quote for everything except wind and hail was between 10 and 11 grand. It was not a bad quote. When you added wind and hail, it was 35 grand. And that was finding someone who would cover it. But a lot of folks just, they pull out. They say, we're not going to quote wind and hail in these areas. And there are another thing that we've kind of seen now at the beginning of the year, we see some carriers are more open to it for, X number of months. And also, especially if you're not in hurricane season, once you get in hurricane season, I think the mindset changes a lot too, thinking about risk from a carrier's perspective. But sometimes they'll get back into it for X number of months, get a certain amount on their books, and then they stop. So yes, that is becoming an issue. There's a couple times it's like at the very, getting very close to a loan closing. It's like we have not found anyone that will cover it. We've even gotten ourselves set up with TWIA. That's the Texas Wind Insurance Association there. That's the pool. And we're still having trouble getting coverages sometimes. And even that is only relegated to a few certain counties.
Now, these are usually annual renewals, right?
That's right.
What are the averages that you're seeing across the United States as far as increases, and how has that changed over the last few years?
Well, as far as the renewals over the last year, maybe let's say around 10% on some that I've seen. Now, if you go back a couple of years, I can speak anecdotally, 2 or 3 years, some of the facilities that I'm part owner in, we've seen it almost double and triple sometimes, from 3 years ago. But I think over the last year, some of the ones we're seeing that we're actually taking over portfolios and renewing for folks. I think we've seen some that were 10%. And actually, in some cases, they weren't self-storage specific. They weren't very familiar with the product. And we were actually able to keep it the same or maybe bring it down a smidge. But for the most part, it's still been going up. And, everybody keeps saying that this year is going to be a leveling off year. I've been reading articles that came out this month that say that we should be leveling off this year. Well, okay, that was before all of the wildfires in California. How's that going to shake out? How are all the things that happen in Western North Carolina and Florida and Georgia? How are those, going to pan out? And what's that going to do to us? We don't know.
Do you know what carriers, or if there's carriers that were concentrated within those areas?
I don't know of any that were specifically just totally concentrating. I haven't heard of any firsthand. I couldn't really comment to that.
Yeah. I know that a lot of them have tried to obviously geographically diversify, but that becomes really hard when you're talking about Florida, Texas, and California, which those three, those have to encompass 60% of the United States population.
A lot, yes. Yes.
That's insane. You're talking about Texas and California, which are the biggest states in the United States, population, economy, everything else. And then Florida's got to be in the top 5. Maybe it's only, maybe New York is in front of it. But outside that, So, I mean, you're talking about how do you be an insurance carrier and play, yet at the same time, not have exposure to these massive markets. And then the exposure that other people are getting, also this becomes tough because you're getting exposure to those markets, even if you're not in them.
Exactly. And, some of the states and how they negotiate with the insurance companies and what they're allowed to do. The insurance industry, as you know, having been in it, it's regulated by the government, just like lending. And they have to keep a certain amount of cash reserves on hand, just like a bank does. And all of these catastrophic events that have happened over the last few years have really drained those cash reserves. And the only way that they can stay in business, I mean, they're still a business. They still have to make a profit. And the only way for them to do that and meet those requirements of the regulators is to increase premiums. And if a state's not allowing you to do that,
like California,
exactly, then what do you do?
And two, not only that, but the replacement cost also in some of these states are not only the highest, they're, I mean, astronomically more than in other states.
Yep.
So this is a really hard problem that we just haven't figured out, I think, in the United States. And I think it's really easy just to make insurance companies the bad guy, right? That's a really easy thing to do.
Oh, yeah.
You also have the other problem then, but where does it come from? And two, by the way, insurance companies are going out of business. So this isn't like they're just, no, they're failing. We saw with the hurricane. We're still waiting to see, it'll be interesting to see if some insurance companies, get taken out from California and the losses there. They literally don't have capital. It is so concentrated and it is so much that it's wiping companies out. So it's not an easy fix. Like it's just have them cover it with what? And so, I think that we had seen such a population migration and growth into areas that are so high risk that this problem is getting worse, not better, where you have all the other areas that you have that are much less risk and prone, they're not growing like the other areas are, which is obvious. High-risk places are often very beautiful. Why? They're coastal. They have huge mountain ranges.
Right.
They've got, beaches. They're like, there's a reason why people want to live there, but they also are very conducive to extreme weather patterns and that are only getting more extreme. And so, as a investor, this issue, looking at how I'm supposed to project out, how do I think about this? How do I say, I'm underwriting a deal. This deal, I have a premium that is $15,000 a year, but I'm worried that it's going to double to $30,000 on a property where that's 50% of my margin. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet, which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you.
Exactly. And that's the problem. How do you? I mean, at least with taxes, you have an idea of how they do it. You can find out how they do it. You can plan for it. But for this, you can't really plan for it. Some of the folks I've talked to recently that have been investors, what they've been doing is underwriting it with a huge amount of padding on their insurance cost, anticipated cost, and also writing it into the PSA that, hey, look, at the time of closing, when we get a final official quote, if it's more than this, we've got to retrade it. We've got to make adjustments to that. So I've heard of some people doing that. And that takes a willing seller to do that. But the sellers also, they're experiencing this too. So they should understand that when it comes to looking at these numbers and underwriting these things, that is a factor that is a wild card. And hopefully, we're past the craziness of it and that you should expect, a certain percentage increase. But you're right. It's how do you? You've just got to either try to force a higher cap rate on it or just quote crazy numbers on it just to make sure you're covered. And that's going to kill a deal sometimes. But that is, the $1 million question.
Now, let's talk about the self-insured parts. The group pooling of assets, whether that's captive, self-insured, and basically everybody, you're self-funding, meaning you're your own insurance company. So everybody comes together. The idea is that you're funding the premiums into your own account.
Right.
And then you're covering the losses with what's in that account, except you need to start out with money in the account. So if there's any losses, that tends to be the hurdle, right? So you need to start out with that cash in that account. Now, captives lots of times are not self-insured. They're lots of different companies. So you have, let's say, 10 storage companies that get together. We're going to create our own insurance pool, and that is a captive. We're going to put money into it. There's lots of tax benefits, things that you can do, and disbursements you can do. But the idea is we can pick and choose. So we don't have necessarily laws that dictate like insurance companies do. So we don't have exposure, and we can see exposure and understand how to handle it. Then extreme claims, you have a higher insurance level, which is a reinsurance, which caps it off. You have two different kinds, but it basically caps off those shock ones if you had mass amounts of claims all at the same time. But the idea is that you are more in control of it. In good years, you get money back. Whereas a lot of people are feeling so burned because they're paying insurance for 10 years. Their insurance is doubled in the last 2. And they go, I haven't even had a claim. But that's because you're funding other people's losses. That's how insurance works. But this is also why everybody gets so mad about insurance. You're funding everybody's losses that choose to live or do things somewhere else that you don't. And yet the insurance company, you have to pay. So that's how it works, right? So when we look at that, I think this will probably be more and more, moving forward for people that aren't in those areas. Meaning that if you are located in the Midwest, the North, and you're not in the track of hurricanes, everything else, wildfires, you're in good, safe areas, you're like, I don't even know how we would have necessarily a loss. And 2, we invest money into our assets that does fire protection. We have access. So you can put parameters on that pool to say, if you're not doing these things, we're not going to cover it. So then you're increasing the odds that bad things won't happen. That's the whole idea between whether, that captive or that self-insurance. The hurdle is that money, though. So then who's going to put the money up, and how do we put it up to get started? We have facilities where our insurance doubled, and we're like, we've never had a claim that was over the amount on our portfolio of that one facility we're paying. Like, right. All of a sudden you go, how does this make, we're in 10 states, we have 3+ million square feet. One facility is paying more in a year than our claims have ever been. This becomes a very financially tough thing, especially because of the fact that you can't predict it.
Right.
So everybody braces when something on the other side of the continent happens because you're worried that your premiums are going to go up. But just because your premiums go up for risk in that area, it doesn't mean that your rates do, right? So just because my insurance doubles, that doesn't mean that market I can double my rates. And that's, I think, the problem with it, where taxes are supposed to be in line with values. Now, they're not, but we can at least contest that. And we also know exactly how the government rules work to decide it. But the insurance, like you said before, we don't know. It's just
that's right,
almost like a roll of the dice. And you get a bad year, storage has had a rough few years. And you're down 2-3 years, and then your insurance doubles.
Exactly. And, people are always asking, how can I lower it? How can I lower the price, these premiums? And, there's a few things that we talk about. Well, obviously, you can raise your deductible. That's one way to save a little bit of money. It may not be a whole lot. Your risk management, your maintenance of your facility, making sure that everything is taken care of and you stay on top of it. You don't have any kind of deferred maintenance. And especially if you're in areas with snow. I mean, I'm sure some of your areas have snow and ice and so forth. Make sure that your buildings are properly taken care of, but also where people are going to be coming in and out. And you don't have any liability claims because of that. Make sure your roofs are in good shape, things like that. But just there's not a huge amount of things other than that you can really do other than just continually trying to get quotes and shop it and see what you can do.
I hate to say this, everybody, but it's just not going to go away. This is not going to be a problem that is going to go away anytime soon.
That's right.
And I think that the actual end type of result is it just lots of these places, you either see a rate adjustment or in not the premiums, but our rents, or people stop building as much storage, which then inherently has, and two, I mean this with every product type. Storage is not unique in this. This isn't something you avoid by going to another asset class. You don't avoid it, right? Asset class, I mean real estate. But then demand picks up, and then you force those premiums to go higher. It is a cycle that we see, right, that happens, but it's not one that we see retreats, really. So the one thing you can do is that process to take it out to bid and to look and to see. Now, how do the insurance carriers view or look at that, though, if you're shopping every year?
Yeah, well, they do pay attention to that. If you're shopping every year, it's like, hey, you're wasting my time. We recommend at least every other year. That's not too intrusive on the underwriters. People don't think about the underwriters and the carriers. They're inundated. Their desks are covered. They're going to work on, number one, packages that are complete and full and have all the information, and also ones that have it come back to them 3 times in the same year. So it's definitely something to consider. If you go to the same one every year and shop it, they're going to get tired of that. But if there have been huge changes in a year, it's understandable. You need to stay on top of things. Like if you make changes, if you do things to your facility that improves it or that could lower the cost, go back and talk to them again, and don't wait till the end of the year.
But that's the thing, is that proactive part. Like a lot of times you're doing things and nobody knows about it.
That's right.
The insurance company doesn't know what it doesn't know. The fact that you installed fire hydrants and that you put a firewall in, and that a new fire station was put across the street from you, and on and on and on and on, right? Well, if you don't tell them and go back to them and say, we've done these measures, we would like, to see a result and not as high premiums or whatnot, they don't know.
Absolutely.
So you do need to be proactive about this and doing what you can to mitigate expenses. And lots of times, wouldn't you agree, Terry, that it's like, go and find out what can be done? Ask, what can we do?
Absolutely. What things are they looking for that will help give you some relief on that price? Like you said, some of the things you just mentioned are great examples on being able to save money. Some of them give discounts for electric locks. Some give discounts for various things. Make sure, if you've got tenant protection, tenant insurance on there, that increases. That's another level of protection between you and the customer. So therefore, between them and the customer, so that it's less likely for them to have a claim if you've got that. So any of these things that you do or change or add. Maybe you added a new gate. Maybe you didn't have a fence. So if you added a fence, you added a gate. Any of those things like that. Security systems, cameras, anything whatsoever. And on the flip side, some of the things that people don't let them know about is the fact that, hey, I just added 30,000 square feet 3 months into the year, and here we are at renewal. It's like they've been uninsured this whole time and didn't even know it.
What do you think as far as, we used to call them gap plans, meaning that we're paying $1,000. This is only concept. This is not how it works. We're going to lower that to 500, but then they're like, we're not going to cover the gate and we're not going to cover the office building or whatever it is. And you say, that's fine. I'm going to keep $30,000 in my account to cover those things if it happens. So then you're lowering your monthly expense, but you're also lowering what you're going to get out of it. But you stash that away to cover it. So do you see things like that, like gap types, cap coverage, or things that you could do to try to lower that monthly impact on those premiums?
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
I think it's something good to ask the carrier. So far, we haven't seen that because a lot of them, the carriers have been very explicit about making sure they cover everything. Some of them have even told me they're concerned about a potential E&O claim if they don't cover certain things. So I think it's worth a conversation, but I don't know if we haven't seen it happen, and we haven't seen anybody that interested so far.
One of the problems is with this, everybody, this is so regulated. It doesn't even matter if you can come up with creative solutions, or they can. They can't do it. So it's just, you got to pay it. The only buffer that a lot of these insurance companies even have today is just to up your premium. They can't do anything else.
Right.
And so it's a really hard environment. The regulation over insurance companies over the last 40 years has been astronomical. And none of it has resulted in any less premiums or more coverage for any of us. And so it's really hogtied us. In fact, there's a lot of legislation, even like how you cover, and you can't not choose. This was one of the big problems that we had with California. Like California literally removed things that you could ask to cover the asset, because to determine whether it was a high risk or a low risk, they said it was illegal to even ask those things. So then you had to cover it, even though it could be a bad property. And you couldn't ask it because it was considered, for some reason, discrimination. These things make it so, once again, it's getting really difficult.
Yeah, common sense has disappeared to a degree.
Yeah.
Common sense is gone, but something's got to give. Somehow, some way, something's going to have to change because you can only, get so much blood out of a turnip.
Any carriers that you are seeing right now that you like, that you're saying these are good carriers that like this space?
We work a lot through Minico and Universal, and there's a new one called We Sure that we quote with Ryan Specialty and some of their groups that they use. Also, West Bend, Westfield. That's the ones I can think of off the top of my head. But like I said, we've got over 10 that we go to and that are happy to give us quotes.
Do you see any localized or state-specific, or all of them national?
No, some of them are only regional. Some of them are regional, and then some are national, but some are regional, and that's how we determine where we go. If we always go to the national ones to see what we can get. The Mahoney Group's another one that we do a lot of work with, but the ones that we know are just regional. Obviously, we do them, and the national ones when we can, just to have more options. And obviously, the ones that are regional, a lot of times they're admitted carriers. So, they're going to be a little less a lot of times because you don't have the fees and stamps and taxes and all that go along with it.
Any states that you do not look at or work in that you've seen, and what are the reasons for it?
So far, there are none. I actually started this vertical last August. So there's still a lot of areas we haven't done, but so far there are none that we haven't entertained. I'm not crazy about California. Texas has been tough, but we've been able to pull them off. And New York's another one that sometimes can be a little bit of a pain, but so far we haven't said we're just not going to do it, or run into carriers that have said we're just not going to do it.
What about size of facilities or size of markets? Is that a determining thing that carriers are looking at today? Like, do they look at it and say there's a definite difference between an 100,000 square foot facility in a city that has 2 million people versus a 20,000 square foot facility in a city that is not near any major market and only has 10,000 people?
I think mostly what they're concerned about is just TIV, the total insured value. So how much is the total value of this thing? So they'll only insure so much.
Did they set those, or is that a third party that comes back like an appraisal that says, here's the replacement value and here's the tiers that you could get?
Carriers, I think, set their own TIVs, but they're definitely using third parties for replacement cost.
Okay. And is there a rule that they use, like we'll only go above a certain amount of replacement cost And is that a fixed thing at premium, or will it adjust as times go on? As we know, I think there's a huge problem, everybody that's listening to this, with your properties are underinsured. I think a lot of properties are today because replacement costs have gone up so much in the last 5 years. And I see people that haven't adjusted their policies. And I'm like, I don't know how you could even replace it to that policy. And that gap may be huge.
Yeah, and we've definitely seen those. Most of the carriers want a minimum of 80% of the replacement costs covered. Some are 90% of the replacement costs covered. So and we have that conversation a lot with folks, and we ask, what do you feel like your replacement cost is for this? You know your facility, you know your market, you know your area. What do you think, based on your experience in the industry? What do you think it is? And sometimes I'll entertain my thoughts from my building days, and I'll give my thoughts on what they should be. And then when we go to the carriers, they come back and it's twice what we thought it was. I mean, I literally had one recently that came back with a replacement cost on a single story climate control that would literally, based on information I just got from a general contractor, it would cost from the slab up to build a 5-story is the same as what these guys said the replacement cost for a single story climate control building was. So, they have their amounts. They're going to take yours into consideration, but they have their replacement costs they're going to use. Again, they're afraid of E&O claims. So that's just something, you don't want to be caught in a co-insurance situation where you've totally underestimated it, and now you're paying a whole lot more out of your pocket than just your deductible. And a lot of people, I think, will get caught off guard by that.
All right. Well, everybody, this has got to be one of your top issues and concerns moving forward. And I know that it is ours and will continue to be, especially in some of these states where carriers are being more limited and prices are rising. So, hey, I really appreciate you coming on, Terry, and being able to talk about this. Where can people find out more about you? Where can they reach out to ask you more questions?
Well, they can just email me. My email address is Terry, Terry, at gojohnsonins.com, or they can just go to our website, do a Google search on Johnson Insurance Self-Storage, and it'll go right to our page, and you can find us that way. But I really appreciate AJ having me on. Again, it's been a minute, and I was looking forward to this, and I really appreciated it.
Hey, appreciate you, man, and we'll talk soon.
All right.